Right. If you're going to panic, panic first. It is Thursday, the 2nd of July, just ahead of the long weekend at 6 p.m. Eastern. Benny and I are delighted to have LaksGanapathi of Unicus Research join us. She is a short seller of some repute and has really captured the zeitgeist this year on the whole story around private credit. Welcome to Benny and the Squirrel, Laks. How are you?
I'm good. Thanks for having me, Benny.
Nice to see you. Thank you for coming.
Perfect. Well, listen, Laks, I think what I really want to do is we're going to go through a few of some of the key issues that you have been covering with your research over the course of the past couple of years. And I wanted to start with when Jamie Dimon makes this kind of statement in terms of hedging his exposure to the private credit world, I think it behooves us to sort of sit up and take notice. Where do you think the banks are right now with their if you like, their intermediary exposure to the sector?
Well, it's interesting because one thing that many investors refuse to acknowledge is how interlinked private credit is with everything, especially with banks. And a well-known credit manager that me and my team recently spoke with said they didn't think that there is any connection between private credit and banks. We were shocked to hear that. And that what it told us is that it conveyed to us that not many are aware. They are happy with the return on investment that they are getting. Beyond that, they are more or less clueless. So with respect to the banks, we have been monitoring. There is a recent uptick in synthetic risk transfers, related to private credit, and they are not transparent with most of the things, and I think that's by design. But nevertheless, there's been an increase in SRTs from the banks to insurance companies. So for us, and then you have the banks stress test, and they all passed, and now everything is fine. So it's kind of, you move the risk from your balance sheet and everything is fine. It's kind of oxymoronic. And for us, that's where the banks are, transferring all the risk and making sure the books are clean. I don't know if that answered your question, but
so just take a step back, because obviously the foundation of the private credit market goes back to the GFC, right? And
yes.
Ultimately, let's be clear, we're dealing with a feature, not a bug, right? They did not want, the Fed did not want, risky credit being funded in the overnight market effectively. So the creation of the private credit universe is by design. It's just that the banks have become involved in the market as a funder to the private equity shops.
Exactly. After 2008, regulations were all over the place, and this is a perfect way for the liquidity to reach small businesses and consumers who otherwise can't get proper credit. Having said that, it's private credit attracted the attention of the mainstream media, for the lack of better words, because we have been following shadow banking for a while. Only reason from our point of view that everybody is talking about private credit now is because they started focusing on the retail investors. For us, that's a no-no. And you really, and then it's a lot of things, right? So retail investors need to be educated, and they go to financial advisors. And I was naive to think that financial advisors would get a kickback. So I was under the naive assumption that financial advisors are doing what's good for their clients. But when we spoke to another source, I was proven wrong because there were kickbacks we heard provided to financial advisors in promoting this particular investment to the retail crowd. So yes, private credit is very convenient, has been very convenient for small businesses and consumers who are liquidity deprived. But attracting the retail crowd is where they did the mistake. And we were holding our position steady that sadly private credit as an asset class will survive after everything is said and done. However, it's now in the shakeout phase of weeding off the retail investors, if you will.
It's interesting you say that. Wait a second. Because, Squirrel worked for banks for a long time. It reminds me of structured products, right? Structured products are terrible products. And the bank or the high net worth, the financial advisors get 2-3 points for pushing those products onto their clients. And this has a structured product feel to it, right? Don't you think, Squirrel?
Yeah, I agree with that. I mean, certain, distribution always has to be paid for, right? So ultimately, are we seeing the kind of fees that these distributors are getting paid? Are they out of the ordinary, or just in line with what other fees they would normally earn on collective investments? Because this is a fixed income instrument. There can't be that much juice around to pay the intermediaries. So is this a bigger spread that they're getting than you would expect?
We don't know, but what we do know is it's getting pushed through to the retail investors through the intermediaries like financial advisors. So if I have to take a leap and assume that, then probably, if you want a specific product to be pushed, they would probably expect a little bit higher spread.
Okay. And then the next question I had just was these synthetic risk transfers, which is where the banks are effectively buying credit protection on their exposures, on their loans to the private credit shops.
Yeah.
Now, we've talked about the channel of these products going into retail, but of course, most of the paper has gone to insurance companies to back up annuities, and so if these insurance companies are taking on most of these synthetic risk transfers, are they not double dipping in the same credit here?
That's an interesting question, and I don't know the answer for that.
Okay.
So
it just worries me that they're getting loaded up. They're getting loaded up with stuff that they're already long.
See, that's the thing. Is just you give an insurer your retirement money, and the insurer promises check every month, and it's supposed to be consistent, and the insurer technically supposed to, correct me if I'm wrong, invest your premium, and that means in a very secure investments, right?
Mm-hmm.
So I believe they were investing usually in government bonds and corporate bonds, and over the last decade, a growing slice, it appears, moved into private credit, right?
Yep.
So it moved into private credit, moved into the loans that nobody trades, and it's like I give my own marks and I give myself an A+. It's a loan that nobody trades, and they are priced by the same people who made the loans, right? And what's that?
It sounds like history repeating itself with mortgages in 2008.
Exactly. And, it's because of yield hungry. Private credit loans obviously pay more than the public bonds, and ownership, because the private equity firms bought or built insurers. And some of the private credit funds, they have their own insurance wing.
We'll get to that. We'll get to that at the end, because I think that's where the denouement happens. But it's really become a problem this year, Lax, when ultimately the liquidity structure is being tested with these redemptions. And it'd be great if you could explain just, how these redemptions are working and the problems that they're creating in terms of, because of the deterioration of the underlying capital, because to fund these redemptions, they can only sell the loans that they can sell, right? So naturally, there's a deterioration effect on the underlying portfolios as a result of that. So why don't you walk us through this chart of yours?
Well, so I will walk you through the overview, and then we can apply it to the chart. So the redemptions and the gating are there, and every single challenges. It's retail investors are. Let me take a step back and say, retail investors and investors are frustrated because they feel like when they want the money out, it's getting gated, and they are furious, understandably. But we did look into their prospectus, and whether it is Cliffwater, whether it is Blue All, they all mention it in their prospectus, and they all mention that the investments are mostly illiquid. It's right
it was in
there.
The small print. Yeah.
It's in the small print, and so the retail investors was told they could get their money back every quarter, happened to suddenly learn that every quarter means you will be gated when everyone asks at the same time. So for instance, in I don't think it's in there, Stone Ridge Lendex. I don't know if you heard about that fund. So Stone Ridge Lendex was the first time we were aware, because we were tracking the asset-backed securities for auto dealerships using the SEC filings, right? And we were wondering where all the buy now, pay later loans are going, who's buying them. And there is no set of links that's given that tells the investors or researchers that where they are selling, to whom they are selling the money to. So we started looking into that, and then Stone Ridge started to gate their Lendex fund. So we looked into the fund, and it's thousands and thousands of pages, and the loans where I can open and walk you through. The loans were range from $2 BNPL for coffee or whatnot to $200,000 unsecured personal loans. It's from Affirm, Stripe, and everything. And most of the loans, when you use the cost basis and the fair value, it's underwater. And that's the thing. So if Cliffwater, on the other hand, on Q1 2026, investors asked to redeem about, I believe, 14% of their shares. The fund repurchased 7%. The 5%, its filings required, plus optional 2% that they permit. And Q2 2026, they announced on June 2nd, the redemption request for the first quarter, 14%. Now it rose to 17%. And it was gated again. Yeah. So what was interesting for us in the Cliffwater, at least, is that S&P, during the first quarter, moved its outlook on the Cliffwater CCLFX fund to negative in March 2026, while they still affirmed an A rating, citing an elevation redemption request. And what was irritating was that S&P cited elevated redemption request and noted that roughly 25% of the portfolio sits in the software. And they did not do any warning. If they had done the warning or downgraded, would the second quarter redemption would have happened? I don't know.
Yeah. So this is your chart again. This is the breakdown of their senior secured sleeve at Cliffwater, right? And it's all. I mean, I assume this technology is all software, right? And healthcare is sort of nursing home roll-ups and things like that. It's not drug stocks, for example.
Yeah, it's technology, healthcare, and we looked into it. They are all private companies. They're all private companies. They are the businesses. And this brings me to MFS. And the reason MFS, at least for us, is acting as a map is because I don't know if you're aware of MFS. It's a random London
UK mortgage lender.
UK mortgage lender.
Well, this is the story that really shot you to fame, Laks, isn't it? I mean, I think you were the first to call this. So why don't you take us right back to the start in terms of, lenders collapse from time to time. That's not amazing, but it's the daisy chain of interconnection that I think is so interesting, and it really highlights for me just how all over it significant, the GSIB banks are all over this market as well. So why don't you start?
They are. And before MFS, I'll take you back to 2025. And if you don't mind, because this is very, very important for anyone, at least this is how we understood this. So I don't know if you heard about Tricolor Holdings.
Yeah, absolutely.
Yeah, so it's a Texas-based subprime auto dealer and lender. We stumbled upon them because one of our sources who has wholesale business called us and said, hey, do you know this lender? I mean, the collateral just drove itself off to Mexico. That was a phone call we received. And they filed Chapter 7 in September 2025. The allegation, the auto loans were pledged as collateral to multiple warehouse lender, double pledging. The same double pledging pattern as MFS that happened in Feb 2026. So with Tricolor, bank losses were immediate. It was disclosed. JP Morgan took a hit of 170 million charge-off. Fifth Third took a hit of 200 million. And then they ended up merging with another bank. The private equity, private credit angle for Tricolor, at least for us, is that BlackRock had taken a minority equity stake, I believe, in 2021. And that funding ran through the bank warehouse line and then went to auto ABS. And that's the exact first bank to non-bank we mapped. And if you remember, that's when Mr. Diamond came out and talked about this cockroach.
Yep.
Right? I mean, you can't talk about a cockroach when you might probably be breeding some cockroaches, right? So, and I mean, it's infuriating for us to see all of this and question ourselves every day, are we crazy? So when Tricolor happened, everybody said it's a one-off. And I was like, no, it's not a one-off. And then within a month or so, First Brands happened. It's an auto parts maker and it's privately held. And the allegation was billions in off-balance sheet supply chain financing. And in this case, the receivables were allegedly double pledged obviously more than once, and roughly $2.3 billion is gone.
Yeah.
And here, the private credit angle, its leveraged loans sat inside a CLO and private credit funds, and the factoring exposure was with Jefferies Point Bonita.
Yeah.
And then there was a Primaland in Canada, which was very small to matter. In the first quarter of 2026, we have MFS. And MFS when that happened, it's not a bank. It was not a bank. It's a shadow bank. It took no deposits, got its money from borrowing from banks and big investors and private credit. The loan book, I think it reached roughly 2 point some odd billion pounds at its peak. So if you would like, I can explain the map. So MFS kind of sat in the middle. Borrowers paid their loan payments to MFS, and MFS was in turn supposed to pass that money on to funding vehicles, and from there to the banks and to the investors. And MFS was the middleman holding everyone else's cash. Right? So the problem is the money in the middle with MFS went missing. So we can go deep into where it went, where they are right now. One of the problem we found interesting is there was a money completely disappeared thanks to MFS. The other problem is same collateral was promised twice. Okay, no surprise there. The third problem is the lenders were showing false numbers. And number 4 is some of the borrowers may not have been real borrowers. Right? I mean, why do we care about this random thing in London? It's a private credit story, but the money outside the banks, but the money inside the MFS belongs to banks. Barclays, Santander, Wells Fargo, Jefferies. Like Jefferies is linked to every single thing. I mean, correct. Please let me know if I'm going a little too deep.
No, not at all. Not at all. What I thought was so interesting is that, you know, you've got GSIBs involved here. You've got regulators everywhere that should have been, you know, watching this web, and the whole thing slid through.
I mean, that's the thing I've been thinking every day. It's just I don't think they know where the money that they lent goes. They do not know. They packaged it so many times that they have no idea what's inside every single loan book. So Barclays, Santander, Wells Fargo, Jefferies lent to it. Alongside, you got Apollo's Atlas SP and Castle Lake through warehouse lines and notes. So when MFS failed, the loss went back to the banking system. And that's our whole thesis. Our whole thesis is like, private credit does not remove the risk from the bank. It moves the risk one step away, and it just completely blinds it.
And I think the best way to explain this is to look at Cliffwater, right? Because this is the classic sort of first point of entry, right?
Yeah.
So walk through how Cliffwater works.
I'm sorry.
So walk us through how Cliffwater as the lender's lender works. So this is essentially, you know, a primary gateway for the banks, right?
Yes. So inside the Cliffwater Corporate Lending Fund, I can walk you through the numbers. There are like 3,039 positions, 17% redemption queue. And hang on, let me go through this. Okay, so this is Cliffwater CCLFX.
Yeah.
Right. So it has technology exposure, healthcare. As of September 30, 2025, the first lien term loans of $22.68 billion across 1,193 position, private collateralized loan obligation and structured loans notes of $7.8 billion across 59 positions, investment partnership and fund stakes $4.8 billion. It's unbelievable. It's just like private CLO in these abbreviations of CCLFX. The private CLOs are the single largest sector bucket in that file of 7.69 billion of fair value, 24.4% of net assets. It's nobody knows. No one can see what's inside it. I mean, correct me if I'm wrong. You used to work at a bank. Do anybody know what's in the CLOs?
Well, no, they didn't. They just relied on the rating, right?
And that goes back to the rating. S&P was very aware there is a redemption. They didn't even bother. I bet you they didn't even bother to look into the loan books. And they said it's negative and still maintained a rating. And within 2 months, you have another redemption.
Right. Yeah. So you have, like, I think it's fairly well understood now that, like, the private credit loans are sitting on some air. Let's put it that way. You know, the BIS came out and said 40% of these companies have positive free cash flow or something to that extent.
Negative, I believe. Negative or positive?
40% have negative or 40% have positive?
I remember reading negative. I have to look at it. Now
well,
I'm confused.
The point is a lot of them don't have free cash flow. I think that's without getting into that. But so I guess what people want to know, or people are concerned about, or, you know, people are not concerned about, is this gating mechanism is essentially preventing bank runs, right? They don't want an SVB. They don't want a Lehman. They don't want that. And the whole genesis of private credit was, hey, there's a regulatory arbitrage that we can run. A lot of the same guys who worked at the banks who wrote the loans up to the GFC are the guys at these shops, right? And so I guess the thing that's interesting is the transmission mechanism to the general banks right now. Because if you look at the market, we have Apollo and KKR and the guys who are running these funds, Blue Owls, completely on the floor. Their stocks are completely discounted. Whereas the banks, whether it's the regional banks or the big banks, at least in the US, are near the highs. So there's a complete disconnect, right? And so what is the transmission mechanism of these going bad to banks? Like, because obviously it all is one financial system. It's not two separate financial systems. And the banks have warehouse lines and all that. So can you, like, talk to that a little bit?
Sure. So what we were looking into it was the lag, the transmission lag between. So for instance, let's go back to MFS. So MFS collapsed and it impacted Atlas, Apollo's private credit fund Atlas. And then how long it took before it impacted HSBC is there is a lag. And the lag is based on what we might be wrong, but based on what we calculated, it's roughly a quarter. So Barclays reported in terms of MFS, Barclays was the first one to report because they began freezing MFS accounts in January 2026 because they spotted some transaction irregularities. And somebody who used to work there is a source of our employee in London. And they came to us and said, hey, Barclays froze this, right? It took a month before it impacted Jeffries. And it took from then, so we can use the time limit for the lag as the Barclays freezing in January. And then 2 months after that, right, the accounting impact happened to HSBC when they took 400 million charge. Now, HSBC did not disclose, if my memory serves right, the name of the borrower and why they took a 400 million charge. Someone in the press, I don't know if it's Financial Times or whatever the press is, the press reported it, but HSBC, as far as I know, didn't mention the charge belonged to MFS. So for us, Benny, the lag that you described, yes, these are all happening. When it will impact, that is our risk. So we are flagging that. We are trying to, with our mapping, see how long the lag will take to impact the banks that lend money to all these private credit.
So are they losing money on warehouse facilities or on direct loans to the funds themselves? Where are they? Where are they? Seems like they're recognizing these losses on the double booking of assets in the warehouse facilities, and they pretty quickly realize that that's sort of fraudulent, and this stuff was all in a queue to go to the ABS market. But have they actually taken any losses or write-downs on the loans to the private credit funds themselves yet?
The banks?
The banks.
The banks, as far as I know, no, because only recently they started showing a line item of the amount of money they give or they allocate to non-depository financial institutions, and 23% of the NDFIs goes to private credit. So I don't think banks will ever be that transparent to show which private credit fund those NDFIs money gets allocated to. So, and that is the problem. The opaque nature of the private credit is by design. All we know even now is how much from each bank is going to NDFIs. And then NDFI, I mean, correct me if please let me know if you know something that I don't, but NDFI allocation for me is like a black box, and I don't know to whom those money, private credit funds, is getting allocated to.
Yeah.
So the only reason that we are looking into all of this is when Tricolor failed, First Brands failed, MFS failed. So all these private funds that borrowed money, if each and every one of them fail or were to fail, which we think it will all come back to the banks. And it also shows how banks, I don't have it on top of my head, but banks have been, at least since 2026 January, consistently increasing the transfer of synthetic risk transfers to insurance companies.
Yeah.
So I think risk is getting like moving around like a hot potato, and all the underlying loans, if I were to say, probably not performing well. Most of them are softwares, technology softwares, healthcare, direct lending, BDCs or non-traded BDCs of direct lending. They have it for buy now, pay later loans.
Mm-hmm. So yeah, I mean, this is the this is the fallacy of mark to market here right now. I mean, everything bar one. I don't know what BlackRock did wrong to have their paper marked down, but everything's being marked at a premium to cost here, which doesn't sound consistent with the story you're telling.
Well, it depends on who's marking it. Are they marking it themselves, or because these are not traded?
They're not traded. Yeah.
Yeah. So it's just like my son draws a diagram. It looks like crap, but I would say, fantastic job. That's exactly how, for me, it looks. It's like it could be a crap, but it's from my son. So I would obviously say it's fantastic. So for me, whenever they say, oh, it's marked to this, that justifies evaluation, or, we are safe from redemptions and all of these stories, that's exactly what I compare it to. As long as nothing is traded. So what are you basing your mark on?
Yeah, absolutely. Okay. So I guess the question for me then, Laks, is, right, the documentation, prevents the bank run. right? Ultimately, these things only bleed out slowly unless there's an incidence of fraud, right? Where things happen very rapidly indeed. So what's the end game here, right? Is it that most of this paper is being funneled down into insurance companies who are repackaging, who are printing annuities off the back of that paper? So, I mean, one scenario that I think about quite a lot is that, you know, this becomes a pretty serious political issue when annuities stop paying out to pensioners, right? Are we at that stage? What is the end game for all of this? Because right now, there can't be a sort of, outside of the fraud events, there can't be this sort of skip to default moment because everyone's frozen.
It's, you know, you were spot on when you said, what if insurance comes and says, like, we cannot pay your
annuity?
And that's the scary part. The scary part is not many want to accept this, and when I say it, it might not be palatable, but sadly the regular investors are going to be completely rug pull, for lack of better words, from this. And private credit, the banks or taxpayers end up bailing it out.
Yeah, I mean, so ultimately, instead of banks getting bailed out in 2008, you're just going to see insurance companies, you know, getting nationalized so that the annuities don't default.
What is the funding mix? Do we know exactly what the funding mix is between retail, insurance, banks?
The numbers are not clear. So the numbers are not there. It's very opaque. And that is exactly what we are trying to figure out by mapping it. We were literally sitting with our engineering team. And, you know, we are creating an ABS product because when we looked into the auto, the negative equity, and all of this, we looked into the credit side and realized, oh my goodness, the deterioration are real, but we can't see it in the equity side. So we started creating a product for asset-backed securities so we can get our.
This is the one you're talking about. This is the one you're talking about.
Yes. So this is the one we are building for private credit. So every loan books we dissect and then we run it, our engineers run it in the programming to see if the loan in Hland is also in Cliffwater, if the loan in Cliffwater is also in this. And then there is an other, whatever data that's available, because these people do a great job of being opaque. So any small things for signal, we can pick it up. Okay, which banks are increasing their SRTs? And are they mentioning what percent of the SRT is related to private credit? So we are trying to do this. And the end goal is how exposed private credit is, and which banks are funding what private credit, and then whether the same banks are we seeing the spike in the SRTs. And here's this question we started asking is that when MFS happened, we started to ask the question, what if MFS isn't a one-off? It wasn't even the first. It was First Brands, was Tricolor. The three asset-backed lenders, three sets of alleged fraud, three separate funders, and none of them could see it, and no one flagged it. And every time, you know, anybody realized what's going on is when they failed. So we are in private credit, when we look into loan books, what we are seeing is a system where the fund holds other funds, the managers fund each other's vehicles, they all transfer through synthetic risk transfers to insurance companies, and they bundle them up and they sell them back to the banks as CLOs. And the same name appears on both sides of every trade, that every angle you look at it, they appear on both sides of the equation. So it's very incestuous. So the answer to your question is, when this will, MFS crossed 5 regulatory perimeters in under 3 weeks without triggering anything, right? It's Ponzi. It's a Ponzi finance. What if, can they, or is anyone in private credit investing in such a way that if the inflows stop coming, can they still manage what they have? The chances are they can't.
Right.
So
we're seeing these request redemptions. How is that comparing to new funds coming in? Because we're talking about Ponzi, like the Ponzi unit of Minsky's. I know you're more about that, and I actually am writing about Minsky as well right now. It's kind of funny. Very Minsky time we're living in.
It's a very Minsky time. So either you have to get new inflows. At some point, I casually compared private credit to kind of like Bernie Madoff, but it's a lot of other things are different. If the inflows stop coming in, it's a problem. But then they have to sell some investments they have to make up for the redemptions. Otherwise, I don't see how they can handle the redemptions. I mean, there is a latest article that I wrote, and if you both are interested, I'm happy to add you to my Substack so you can review it. So in Cliffwater, there is a fund called CPEFX fund, right? So that fund has roughly $251 million, give or take, in money market. The rest are all in illiquid funds.
Yep.
So, even if you wanted to sell it, let's say you sell the 251, you have the money, but if you have more redemptions and you need time because you have to sell other things that are illiquid, and
okay, so I've
am
got
I missing
this
something?
This riddle me this. Okay, you've got Saba Capital, you've got Bose Weinstein. Okay, going up with a tender offer on the Blue Owl funds, Blue Owl BDC this year, 1% take up. You'd have thought, given all the scariness around liquidity of these assets, I would have taken his arm off if I was up to my neck in this stuff, right? Yeah. You take your pain, it was a 35% discount to NAV, but who knows where this stuff clears? This is you always pay up for liquidity in these types of scenarios. Why was the take up so low? I just don't understand.
And I think this echoes to what's happening with the banks that are lending to subprime consumers in the auto loan. I mean, Ally Bank, it's going to haunt me in my nightmare for the rest of my existence, because they should not be trading at 40. And all the loans they bundle up and they put it in asset-backed securities, and they are not performing well, and nobody cares. And we heard anecdotally from one of our sources, who's a wholesaler, and he said, "Oh, I heard from so-and-so who brings the car to the auction to sell it for the bank. And the word is, all the banks are in cahoots with each other, anecdotally, and nobody wants to be the first one to come out and say there is a problem." And that's why, if you see, none of them are increasing the provisions for credit losses as much as they should. And we were also told that you will see in the news when subprime consumers, they can't pay the loan. You will see in the news that Wells Fargo, Bank of America, Ally, they are doubling down on originations. So that's because the word is, the more you originate, as in you give the loan to anyone with a heartbeat, your originations will show as increased than you have any delinquencies or default. So the higher the origination is, relative to that, the defaults and delinquencies will look smaller. So technically, you will think that if there is a problem, they will limit the originations, increase the provision, and do something else. No, there is an extend and pretend, and things get worse. You double down and increase the originations. To answer your question on private credit and Bose Weinstein, I don't think any private credit at this point wants to acknowledge that they have a problem. So they are doubling down, and the more redemptions they are, I think their mindset is, this too shall pass. Let's just keep going, and maybe we will come on the other side without any problem.
So, I mean, who just educate me a little bit, Laks, in terms of the people that Bose Weinstein was making this tender offer to, right? Who were the owners of that Blue Owl Capital BDC that were being offered that? I mean, if I was to look at the cap table of Blue Owl BDC and the guys that would have got that money good cash, okay, at a discount from Bose, is it all the same CLOs that you're talking about? This sort of cross web of ownership?
Maybe. I'm not sure. I have to look into it. It's very, I'm being very, very careful in what I say, because I said something on Twitter. I don't know if you follow me. I said something, okay, I'm going to dissect TCP loan book, and I wanted to see how it crossovers with the other fund. And somebody told me, oh, this is the perfect time to mention on Twitter that you're not suicidal. So this is like a very very sensitive topic. This entire private credit is by design supposed to be in the shadows. By design, nobody's supposed to know what's going on inside it. There were well-known reporters in mainstream media reached out to some private credit managers, and they were either completely ignored or told that everything is fine. So this is a kind of situation we are in where no one is willing to give an answer. So
that's true. I mean, this guy's a bit of a classic. And we won't talk about data centers specifically now, but the interesting thing, this ticker OTF, Blue Owl Technology Finance Corp, right? This was a private BDC, and they were getting redemption requests. They clearly couldn't cope with the redemption requests, so they said, okay, what we'll do is we'll list it. And so, they said, well, this thing's at NAV in the high teens, right? Well, no, it isn't, right? You have got that instant realization of $4 or $5 a share, and it's been bleeding out ever since. So I don't really understand how the ostrich effect can continue when we've got all of these public data points about where real NAV is, right? I mean, I tend, bad habit of mine, but I tend to believe in markets as a price discovery mechanism, and that looks pretty straightforward to me.
Me too.
And that CEO, that co-CEO, was particularly defensive around the topic.
I mean, everyone is who are in private credit are defensive, and if you see banks are trying to stay away from it and not acknowledge, it's just the they wanted to come out and say, hey, we are issuing SRTs and all the subtle signs, but everyone is doubling down. I don't know what kind of psychological game they think they are trying to do and get away with it. It's just that the risk is getting transferred. And if I were to be completely blunt, I think they are using the entire retail investing community as an exit liquidity to just flush everyone out.
And we saw the, I don't know, remember exactly when it was, but we saw this push to allow 401ks to invest in this stuff. And
exactly.
I also know that, I mean, it's not just retail though. Like, there's a lot of pensions that have been in this stuff. And, we had talked to a pension that we were trying to get the business of, and they were full of private credit, like just full to the brim, and didn't know how to get out. And the secondary market is like 20-25% discounts to try and get your, to offload it. And so, it's definitely not a situation where anybody who's sitting in it now is feeling good. But, the question is when, is it that it's overly discounted? Like there's people who are coming in looking at the BDCs, they're looking at the private equity guys, and they're saying, or private credit, private equity, and they're saying, well, look at the disconnect between the banks, or this stuff, NAV is at a huge discount. Like, what is it, for our viewers, when is it that they're interesting buys? Because I remember buying credit in December of 2008. There is a point where this stuff will be a buy. And I'm not saying now, I'm just saying, what do you think about what are you looking for as like a contagion or a tradable bottom, or what's the level? However you're thinking about it.
So yes, and that's a great question. And I'm not here to say private credit is all doom and gloom. What they are doing is like it's not clean. It's a high interest rate liquidity. What private credit is doing is right now, well, the question you're asking is what finally causes everything to break? And the answer is nobody can time it. We cannot time it. We are trying to. What you can do is that we can see the redemption spiral. And the redemption spiral, if you look at it from mid last year to now, it has gained some steam. 2 consecutive quarters of gating across CCLFX, HPS, BCRAD, Apollo's ADS. Unmet request obviously will roll forward, and the queue will continue to extend, right? The second one we are watching is as redemption continues to gain momentum for the remainder of the year, the PIK accumulation is also something we are watching. Fitch rating calls the PIK is default is around, I believe, 2 or 6. I don't know. But I think the way they define it, I might be wrong, is that when they move from the cash to the PIK, they consider that as a default. I don't know what's the real default for PIK is, but BCRED, for instance, PIK share from about 1.8 to about 6.5% under 3 years, right? ADC PIK income roughly tripled year over year. So that is something we have to watch, the increase in PIK in addition with the redemption. And then we have to keep an eye on for more cockroach. We are tracking what's the weakest link in terms of, is there any other MFS, any other first brand? So in addition to tracking redemptions and increase in PIK, we are also tracking any potential fraud happening in similar to first brands, Tricolor and MFS, right? Because fraud always acts as an accelerant for already existing redemptions. So first is redemption. Second is we are tracking PIK increases. Third is we are tracking any fraud or cockroaches happening. And the fourth, we are also tracking SRT. We are tracking synthetic risk transfer tranches that are financed with 40 to 60% haircuts, daily margining in some cases. And what I wanted to mention is that the United States, from our point of view, is kind of in an information vacuum, and that's kind of scary. So the information on private credit is being released in Europe by European banks. We are using that to see as like a signal for us to see how long before it cascades into the United States, because there is no documents or surveys that's being conducted in the United States for private credit, as far as I know. So we are using the signals from Europe. And after SRT, we are also using the any other problems in the insurance company, because the ECB's, I don't know if you reviewed the May 2026 Financial Stability Review. They named insurers, not banks, as the entities most exposed to the private credit shock in Europe. So
that doesn't surprise me at all. I think all roads lead to there. And so, I mean, ultimately, what you talk about, Laks, is a world that is frankly completely opaque and probably stays that way. But we do have, some windows, if you like, on that. This for me, there are the most obvious sort of look through to how things are going. I look at Apollo now that they've absorbed Athene back into it. That's the turquoise line here. And then there's also ticker FG, F&G Annuities and Life. Now, this is only a $4 billion market cap insurer, but it is, if you like, it's a pure play on the final receptacle of this paper, right? And, these things have, both Apollo and FG have rallied quite hard off the March lows here. But I still think, that these are probably the best window into underlying health, if you believe in market efficiency, right?
Well, it's for us, the way we look into it, at the end of the day, if you dissect the insurance companies that are holding the SRTs, they're also holding the pensions, and that scares us. The scary part is the retail investors, the regular consumers, are the one who are going to get completely wiped out at the other end of this trade for private equity, private credit.
Yeah. Yeah, it's difficult. I mean, it's still not clear to me. I mean, it takes a long time for annuities to stop paying out, right? But actually, if we are talking about sort of Ponzi mechanics here, actually it might, and the paper's all picking, it's not cash flowing. It actually might happen a lot quicker. Dare to put a timeline on it?
The second half of this year will be a little shaky, considering it's the midterms in the United States. I try to stay apolitical. So we expect volatility for until November of this year. So first half of next year, if the redemption wave continued to happen in private credit, which we think it is, and as the banks continue to transfer their risk into insurance companies, and picks keep on climbing, which we are seeing it happening, it will happen in the first half of next year.
We've got a timeline. Laks, thank you so much. Thanks so much for filling us in on this. Just before we finish, could you tell everyone about Unicus and about Minerva and how they can follow you and your work?
Thank you for having me. Unicus Research is a shop-only independent research firm. We are located in Connecticut, United States. And you can go to our website, unicusresearch.com, and reach out to us. We take in institutional clients and selective individual investors. And we also have a newsletter where we cover private credit and consumer credit and credit in general. It's contrarianunicus.substack.com. And we currently have 4th of July discount for founding member. You're welcome to check it out. And Minerva Investment Management is our upcoming short biased management fund. And at the request of a lot of investors in the United States and overseas, we are about to start this fund in a month or so.
Well, best of luck with the launch. I have to get my words out right.
Thank you.
Happy 4th of July weekend. Thanks so much for joining us on Benny and the Squirrel. That was fascinating. Thank you, Laks.
Thank you. Thank you so much.